Good afternoon, everyone. My name is Vinod Kenny. I am, for all of you, um, I'm actually a stand-in moderator. The original moderator apparently had some kind of an emergency and was unfortunately not able to join us. So they asked me to step in. So I'm going to do the best that I can in being one. And this is a topic that does come up fairly often, right? Are we just, as investors, providers of capital alone, or are we more than that? Are we literally your business partners in helping you to really build and scale your businesses beyond the capital that we provide? And that's an interesting conversation that I hope to have with the panel. The panel has already been sort of introduced, and you know, I prefer to stand, so I am going to stand. And then for all of you who have comments, brickbats, questions, uh, please wait till the end. And I'm sure our panelists will be very happy to answer whatever questions you guys sort of have. So let me sort of get started out with asking you, all of you, the same question, right? As investors, how more involved are you beyond the capital that you have provided in sort of helping your companies with almost everything, right? Go to market strategies, um, capital raising, talent development, pricing, everything, right? I mean, I remember when I was an entrepreneur, my investors were literally like my spouse. You know, there were times when my spouse would not listen to my rantings the way the investor would listen, and these were conversations that I'd sometimes had at 10 o'clock at night. How much of that is still prevalent, or how much of that has actually increased over the last few years? Let me start off with you.
Yeah, I mean, at Sprout, I think we are more seed stage investors. There are two areas where we end up providing some mentorship, some thoughts to the founders we invest at. One of them is strategic advice. Personally, I've been in the investment banking deal making journey for over years. So there are a lot of times when founders whom we have invested with reaches out on subsequent raises, not from a banking mandate perspective, but more from which investors to approach, warm connects to those investors, which is the second thing, which is network access. And the network access is just not restricted to future capital raise, but also access for hiring talent, giving some warm connections or warm leads in terms of opening up market access or product access. We invest, like Amit mentioned, we also invest in consumer brands. At some places, there is synergy between the companies we invest in. So we've opened up channels for certain D2C brands in terms of going offline through another portfolio company of ours. So those are the kind of warm introductions which we can make to some of the portfolio companies. On the strategic advice, obviously, a lot of time the views sought out is more from subsequent rounds and from market access perspectives, largely because I bring the skill set of being in the deal making journey for 20-25 years, so end up advising founders on that aspects amongst the portfolio companies.
So I think Vinod, I'll answer in the same fashion, which the way you have put in the question earlier. When you started, it was more like a spouse, and the spouse don't allow you to sit with another lady. So I run an accelerator with the name of Marwadi Catalyst. From the T-shirt to the watch to the mobile, the jeans, the undergarment, and the socks, everything I'm wearing is my portfolio company. So not only the other than the shoes, I think that is what is the pending. So we date our startups. It's all not only the advice, but we also become the brand ambassadors to the portfolio you engage. I think that's where is a bit difference between the late stage investors versus an accelerator on the floor. accelerators are usually the people who have been there, done that, struggled, or maybe it's a community of people who want to give back with skin in the game. So they also invest. We do have a Cat 1 fund of 100 crore. We have invested in 90 plus companies. And I think our mindset was to actually support. And as an accelerator, we have 3 chartered accountants, 1 full-time lawyer, and a company secretary, and around 15 people in digital and technology. The idea is that whatever is your weakness, because at early stage of startup, you can have any challenge. Starts from technology to legal, and you always believe to have a second opinion, and that makes your life comparatively easy. So it depends upon if you really go and work with an VC or an investor. It may not be right because the mindset is different, right? They will support, but if you really want to date somebody who is invested, it is to be with an accelerator. Don't treat them as a investors per se. Expect at least a 50K check. I don't mind that, but then they are the ones who will sit with you. They will also try to share you which investor is good. They will also actually try to convince the investor this is the way you need to come, because there must be somebody who is carrying that flag. They are the ones who are branding, and they are also sitting on the next side of the table, which is like more like an investor. I think that's what I suggest all startup founders, whether you've gone with the traction or not, you should go and be a part of an incubator and accelerator. Then only reach out to the VCs. It will make your life comparatively easy, and the chances and possibilities of success is comparatively better. Thank you.
Sushil, when you talked about being a brand ambassador, I was thinking about this and saying, how did you really construct your portfolio here? I mean, if you started thinking about all of this, I'm sure you started saying, okay, if I have to be a brand ambassador, I'm going to pick a clothing brand, an undergarment brand, a watch brand. So you sort of interestingly built up a portfolio around that. I mean, I'm digressing, but I was very interested in knowing how the portfolio got constructed.
So, I think it depends upon who starts the accelerator. So, I started and run a technology company for 15 years, exited. I acquired an agriculture farmhouse in east of Africa, in Ethiopia, back in 12, exited in 17, and I created a IT park. And I run my company from Jodhpur. So, Marwadi Catalyst is based out of Jodhpur. We are a brand ambassador, flag bearer for a tier 2 cities. We do have an office in Bangalore in HSR. But the idea is I've struggled a lot in my early stages when we started from a small city, when you were actually a backbencher. I was a backbencher. So I think I've realized that if you have a good supporting tool, I was lucky enough to have good people on the board, the ones who have invested in me, right? And that's why I've got good exits, but from the technology to agriculture, infrastructure, all 3 different stages. So I believe, I started investing in startup more like a passionate investor, but then I realized I'm enjoying it. So my first all investments were strategical, something I wanted to do, and that's what I suggest all the investors. If you really want, whatever you feel you have missed out, specifically I see the first row with more professionally fine-tuned people. I've missed a lot of things. I want to do a lot of things. I invested in a cafe, co-working space, multiple activities. I missed out a lot of things in my journey, right? I decided, let me invest, let me an external advisor, because you've traveled. When you travel 30, 40 countries, you have a lot of experience, network, knowledge, and a positivity. So I think that is very important. It's at times don't know about the domain, and actually investors should not go inside the domain. It is a lot of other supporting tools they are supposed to help.
Thank you. Amit, you and I have had a lot of conversations around the whole value addition beyond capital. I mean, this is not the first time, at least the 2 of us have had this conversation, right? And there have been enough dinner and drink conversations around this. I mean, I want to get your perspective, since with Fluid, but also beyond Fluid, you do a fair amount of work with a lot of consumer-focused startups and brands and entrepreneurs as well.
So I believe I am very new to the Bangalore ecosystem. I come rarely because normally you will find me in tier 2 cities, and most of the time we have met in Chhattisgarh, Bhopal, and those places. I believe this is the first time in metro cities where we are meeting. So my name is Amit Singhal. I run a fund called Fluid Venture, where we invest at pre-series A level only in direct-to-consumer brands. So our forte is only D2C, where we invest. I am a chartered accountant by education. So I started this fund in 2021, and we have made sure that we create a line between being an operator and the investor. So we don't enter into the operation part of the business at all. We don't ask our founders to share everything with us. So we are truly a strategical partner there. So we love helping founders, but on the same side, we create a thin line between the operators and the investors. So what does it mean? Because we have a common type of portfolio. Everyone is D2C, everyone is struggling with meta cost, everyone is struggling with hiring, how to give an ESOP. So we try to find out the common problem in the market and want to share with the portfolio companies so that they do not do the same mistake which is other founders are doing. So we are truly work with them how to reduce the ROAS, how to reach out to more and more customers, what can be the potential of micro influencers, whether celebrity is the right time to be onboarded at that time or not. So these are the strategical decisions where we help them. Apart from it, being a chartered accountant, I help them in learning unit economy, financial statement, how to make sure that there should not be any slow moving inventory, because in most of the D2C play, you will find people keep selling, but they don't realize that there is a slow moving inventory as well lying in the warehouse, eating up the rental part. So these are very common problems where we have a credence call every week with our portfolio company to understand more about their problem statement and to help them either in-house or through an expert through which they get to know that how to resolve this problem. So we are more towards problem solving, not like an operator. So that's two cents.
Thank you. Sunil, one of the things that was fairly common, within the private equity world is the leveraging of operating partners, right? Private equity across the world tends to have a fair number of operating partners who bring operating experience, and they tend to work with portfolio companies. And this is largely to help scale businesses up. You're also seeing a lot of that it's fairly common within venture funds in the Western world as well. India, it's not relatively been that common, but you're starting to see a lot more of that. One is the emergence of what they call as operator VCs, people like us who have run businesses before we actually became investors. And then, of course, the fact that more and more early stage and growth stage funds are also bringing in operating partners, or at least operating experts, to actually sort of help with the portfolio. Are you going to see a lot more of that happen with funds, one? And two, how open are portfolio companies to something like this? Because personally, I've seen mixed results. And personally, I've also seen mixed responses from portfolio companies. There are some, I'm sure there's a bunch of them here, who will pretty much say, got you your money, thank you very much. Once a quarter, come listen to our board meeting, and then, I'll get you whatever you want. Whereas there are ones who are going to be very needy, right? Who will pretty much call you almost every day, I need this, can you help me with this? So somewhere in between, there's a happy medium also. So what is your thoughts around that?
Yeah, so interesting question. I think, it's the second question can actually be answered through a, show of hands here itself. So how many founders here actually want investors to be involved in operations? I
And
can
you
see
can
a
be
fairly,
honest, right? You don't have to be nice enough and says, no, I'm going to do this. If you only want money, say that. Just be blunt.
yeah, it's probably 5-7 hands in an audience of probably 40-50. So it's a perfect reflection of where our portfolio companies also are. Amongst the 18-20 portfolio companies, I think probably 30% of the founders are the ones who actually seek a lot of operational related advice. Most of the other founders do reach us out for some kind of advice, but mostly around a subsequent round, in terms of structuring a subsequent round, especially in times like this where capital raise has not become easy. That's where most founders come to us. But however, at the seed stage where we invest, we mostly the first institutional capital in most companies we invest into. We tend to put a little bit of time to prepare the company for the next raise. So we chase founders to build annual business plans. We chase founders to give us a lot of data in the initial days of the journey, because we want them to get habituated to this and prepare them for the next phase. Some founders don't like it, but then we've been persistent with our chases to get them to that journey. But like on your first question, I think the second one is very similar to what the audience goal is. But I also have been in the banking side. While there has been an influx of operator VCs or even private equity late stage funds, having operating teams sitting within them. I think that proportion, while it's catching up, is still a small proportion. In my view, about 15-20% of the funds are doing that. A lot of the others are still deploying capital. They do some kind of value add in terms of either network or strategic advice, but that's it. I mean, beyond that, I've not seen many funds providing operating kind of leverage. That's probably restricted to 15-20% in my experience.
Sushil, I'm sure as part of your networks, you do sort of get into those situations also, right? Where your expertise, both domain and operating experience, and more importantly, your business acumen also comes into play. And a lot of times there is people who ask for it. As early stage angel networks, um,
As accelerators, not angel
oh,
network.
sorry, as an accelerator, as a venture accelerator, which is what a question that I was actually going to ask you. How has that model changed? And do you see that happening more and more with venture accelerators, where there is going to be more and more domain experts sort of stepping in to help some of these companies in the very early stages? Because amongst all of us, we know this. Building business in India is not easy. It's one of the hardest in the world. So any help that entrepreneurs can get should be appreciated and taken. So from that perspective, I want to.
So I think, Vinod, as I said, the name of Marwadi Catalyst is very typical. Traditional PL players who have a lot of network, but they have a money in the floor. But they actually know the domain knowledge. It's true. Marwadis do have a good domain knowledge. They have a good network by and large, and I think they also help in planning and strategizing the activities more often. So I think one thing I want to say that accelerators are usually being invited, being chosen by the startups if they really need a input and insights, because they don't write a larger check on the floor. And I think what I've seen is we have never done a demo day, irrespective of having a 90 plus startups portfolio. And I think 70% of the startups have raised next round of funding, 10 plus exits. So I think it is not only about raise of a fund. Sometimes you invest and you realize that this is not the right model. You sit with the founder, say, hey, Sheel, you need to go out and somebody needs to come in. So I think irrespective of strategy, in terms of network, in terms of pitching, in terms of storytelling, in terms of which is the right market fit, or maybe pricing or a strategy, or at times giving them a banking network, I think that's very, very relevant issue, because I think everybody will agree, specifically the investor fertility. The biggest challenge and the failure in the startups is because of the founders dispute. So the biggest advice which an accelerator, because and at times if the fund or an advisor do have a pocket to write and pay off the founder who wants to exit, so there are a lot of strategical insights which needs to come on the floor. And I think our role is 90% that, and I think only 10% is towards the finance and the next round of funding. I met first time to Sunil, although I know Amit from a long, but usually we do not intend. We get them ready to get it pitched, and the model is good. And I think one thing I'll share, even after this tough time, which is a tough time as on today for the ecosystem, we also share our founders to be sustainable model. You can't be all expenditure, all expenses. I think plan B is very, very important, that if plan A fails, how to sustain and survive. So what I've seen as an accelerator, we are all engaged from morning 6:30, 7 o'clock till 6 o'clock, advising from the financial projections to planning to hiring to everything on the floor. I think financial connectivity is only 10% of the total initiative. I think, and we have seen. We also do a operational activity, operational VC, what you say. At some of the places, if you have invested in some idea, the founders don't work, they feel it's not working, we don't mind acquiring the companies. I have shared a case with Sunil where we have invested in a company, founders say it is not the right model, we are pivoting, we acquired and we made 100x. We appointed a CEO who is a professional and made 100x growth in the company. So we give such case studies at times to our invested founders. Hey, this can be done. You just need to pivot and you need to fine tune your activities.
Great, great. Amit, do you think this is going to become more and more the future, at least in India, for early stage venture accelerators? A little bit more of an involved hand holding for some of these companies rather than just being passive? early stage investors?
Yeah, sure. As you mentioned in the beginning, India is a very tough market. It's not an easy to crack, and definitely every startup need handholding. So earlier there were no cases available in India where we have seen venture studio model or the operator-driven model. Now we have seen that multiple companies are coming up where they are helping budding entrepreneurs as a partner itself. So definitely, if I will have to do a partnership with a startup, that will not be possible for me because I have never been into the startup as a founder. I always start like an investor only. Earlier, I started like an angel investor and then move to the fund side. So definitely, if I will have to start like a operator-driven model, that will be very tough for me. But if we will go to those founders who have created the business, they have took a good exit. Now they don't want to operate their own, but they want to help other through a partner. So venture studio model is best coming up in India, and I believe that will be the future as well. Because if as a founder, if I had to start, I would definitely like to have a hand holding through a partner who has similar experience in the past itself. So to answer your question, definitely venture driven accelerator program, venture studio, or the operator driven model, that will prevail and that will do very well in India. I strongly believe that.
So Sunil, let's assume this crowd here wants more than just money. That if, I said, let's assume this whole crowd here is looking for more than money from investors. In your experience and with the companies that you have invested in, what is typically what they come and ask you for, or at least you or your team? Is it access to customers, access to investors, access to people, refining the strategy, pricing? What is it that you're most called in? Because all of us have had some segments, right? Like for example, with with the companies that I have invested or where I sit on the board, a lot of my time goes on one of course on the financial aspects because I come from that background. But a lot of it also goes towards helping with networks and actually helping them with potential partners and customers. Half the time I'm doing business development also for some of these guys. So that's one question that I want to ask you. What is it that they're typically asking you for? And because it's sort of a very gray, fuzzy area as to what value add is.
You know, I think I'll take a slight deviation from the question you asked. One, as investors, I think most startups which reach out to us primarily reach out for money. But on the flip side, the way I look at things, the reason why we are investors is because we probably don't have the entire capability which a founder or set of founders bring to table in terms of execution of a business plan, right? We are buying into their story, into their vision to execute that. Uh, and in that journey of that execution, in the journey of their vision, there could be pain points which they face, right? And these could be multiple pain points, across ops, across talent, across strategy, across finance. And we may not fit, the capability of giving them advice on all those aspects. The one aspect where we fit very well in terms of, addressing that capability is, of course, on the fundraise strategy, on the strategy of business positioning, storytelling, on the strategy of pivoting a business if it requires for them to do so at that particular stage of their ecosystem, because we still seed stage investors and we've seen pivots within our portfolio company. Uh, During COVID, we had portfolio companies where we reached out to founders and said, cut yourself thin, but don't cut yourself so thin that you don't survive, right? So we've given that advice to founders. They were founders who were aggressively ramping up at that time, and we said go slow. So we have proactively worked with the portfolio companies at various aspects, but I think more at the macro level, at a strategy level, rather than at a business or an ops level. That's been our larger input to founders, or that's where most founders have reached out to us for. Of course, a lot of founders come with an expectation because I've been a deal making business for 20 years. They expect that once they've taken a check from Sprout Venture Partners, we'll ensure a subsequent raise. But we make this very clear to founders that these are two independent businesses. The investment banking business will pick your case on merit, and there is no influence whatsoever. So we make that clear to almost all the portfolio companies before we engage with them on an investing journey.
Same question. So I think I give a simple and clear cut example in why founders come and why they like me or like Marwadi Catalyst by and large is that we tell them and train them to become a deal maker. Sit, don't negotiate more. Whether you're hiring people, whether you're firing people, whether you're raising money from a next round, or even if you have to do any deal or getting acquired or you're acquiring anything, you need to be a deal maker. You have to be a good dot connector. You have to be in there. And one thing I want to share as an accelerator, that's what I'm saying. Emotionally, you have to be different. Only I think 15% of our startups, has failed. The reason is if the founders are doing good, as a VC, it's tough for them to support. But an accelerator, they give them a year capital. If the founders are doing that, run out of their cash, and if they're good, their focus is good. Even if they have to pivot because of the government policy, because of the founder or anything, a good angel investor or an accelerator, because accelerators have a comparatively large deep pockets, they do not mind giving you a year sustainable capital, which is most important because at times, because startups they raise a small money, they are more passionate and they are experimenting a lot of things before they get their idea right fit on the right highway. Small is there. So I think one thing which we fine tune, and we also try to tell them that if Amit is successful, we can ask him a financial advisory thing, we can ask him a legal thing because he's a chartered accountant. But if you ask him a strategy or a marketing or a branding, is not his domain. Most of the founders fail if you find somebody successful or a professionally fine tuned or doing a large activity. You should not expect everything. Money is not a parameter of being intelligent. That's the biggest mistake most of the founders does. So I think that's what आपको थोड़ा क्या है धुंध हटानी पड़ती है, ऊपर से मलाई हटानी पड़ती है, फिर आपको टेस्ट कराना पड़ता है क्या टेस्ट है और रियलिटी चेक देना पड़ता है. तो कभी कभी आपको घुसना नहीं पड़ता बिजनेस में, आपको रियलिटी चेक देना पड़ता है. और क्योंकि एक्सलेटर्स आल्सो राइट स्मॉल चेक, their ideas are largely accepted with the founders. That's what we do, and that's what our founders enjoy with us. Although some founders have grown big enough, तो उसके बाद भूल जाते हैं, but ठीक है, more or less we enjoy the journey.
So, Amit, how much effort or how much of your network do you extensively end up leveraging to help your portfolio raise next round capital? Because that's an area where a lot of work happens from early stage investors, right? So I'll start with you, and I think I'll go down the.
So definitely, being a VC fund, our exit is depending upon the other larger VC. We called ourselves as a micro VC fund, where we come at a early stage seed or pre-series A. Unless and until our portfolio company raise larger round, it will be a deadlock for us as well, because definitely we are putting 2 to 4 crore rupees in the company, but in D2C, that lots of money required in the growth stage. So definitely, as a VC fund, we keep exploring opportunities with other larger VC funds that at what time they are looking for this particular category or at the stage they want to get into this particular business. So based on that, definitely we keep talking with our network and keep exploring possibilities to have a next round of funding for our portfolio company. And you will be surprised that out of 10 portfolio companies, 9 have got next round of funding within 1 year when we invested, because we had a different type of portfolio companies in our portfolio, like Coparo Clean is in toxic free, this washable things, Promar is in undergarments, so all Beauty Wise is in beauty products. So based on the different taste of different VCs, we keep exploring that, and we give an exposure to the portfolio company so that they can pitch to these VCs much ahead of the time, so that they can be in touch with them and can get next round of funding. Apart from it, we keep talking with our portfolio company on the balance sheet aspect as well. So I am of the firm believer that the strategy should be that even if the portfolio company doesn't get the next round of funding, they should be survived, and it should not be the case of a closer thing where we keep focusing on the growth as well of the company. Apart from it, path to profitability as well. So we keep eyeing on the cost of acquisition of the customer, how we can reduce the cost of the product itself, so that with the growth they reach to a break-even point. It should not be the case so that because they don't have funds, they are shutting down. So every time we keep eyeing, at least even if you are not able to grow, you should be able to reach at a break even, and even if with a small growth, you should be able to keep moving.
So, quick answer as to how much do you end up leveraging networks, your own networks for follow-on capital for your portfolio, or do
Alex,
you sort of get actively involved in that?
so very simple, sir. I think networks matter a lot, and I think if your network is good, it really helps the companies you invest undoubtedly, because network from all sense, not only from growing, from exiting to getting a SME IPO done or a main board IPO done, everywhere. Man. I think network plays a big role, and that's why I think they need, startups needs should do a very good close relationship with the investors.
Yeah, I mean, the same question, right?
Yeah.
I mean, I would say that most of the companies we've invested are capable enough. They've survived without a cash flow strain on them, except for one, which had a business model linked to COVID. It's not necessary that all of them would have gone and raised subsequent capital, but except for one, all our portfolio companies, have been scaling, growing businesses without the need or without having us to interfere a lot. The only place where we had to interfere in terms of figuring out a strategy was on one case, but otherwise founders have been savvy enough to reach out wherever they've needed a warm introduction. We've done that. We've got specialist investors for a few of our portfolio companies related to the industry they were operating in. So one of the companies was in the gaming space. Not many investors at that time on the gaming space. We got an international fund within which is a gaming fund to invest into that company way back in 2018. So we've done that with some of the network, with some of the portfolio companies, but that's probably been only 20%, 30% of the cases. We do introductions when they ask for. I mean, that's something which we continuously do, but we haven't had the need because I think maybe the founders have been great enough, thankfully, in reaching out to the networks they have had.
So final question. I know I'm probably holding all of you back from lunch, and I sort of very briefly alluded to this. Where do you draw the line between active involvement versus just being a passive investor? Because it's a very fine line, and where do you sort of see that where you sort of sometimes feel unwelcome and saying, "No, hold on."
I will answer that from a legal construct perspective. The day we lose our board seat is when we draw that line. But generally we end up having board seat for at least 3-4 rounds. The moment we lose a board seat, and that's a stage where companies got more capable investors to sit on the board and drive them to the next stage.
So as an accelerator, I'm very clear. Any founder wants to date an investor, he should be with accelerators, and accelerators like Marwadi Catalyst. If they just need a capital, accelerators are not right fit. That's what is my final statement.
Amit?
So my line is very simple. So I make sure that whatever help a founder is looking from us, we are happy to provide those helps, and we don't forcefully give anything which he don't want to do. So it is in a way, if he need any advice, he want my involvement, he will come to me and will ask, sir ये advice चाहिए या इसमें आप मुझे help करो, forcefully.
Thank you. Thank you, Sunil. Thank you, Sushil. Amit. This was, I think, a conversation that we can still continue to have. But in the interest of time, and I know, for the fact that people here are probably very hungry, we will probably need to end this conversation. And I'm sure these investors will be available for you guys to ask questions, get feedback. Yeah. End the session. Thank you. Thank you once again for participating.
Thank you so much to